I've overheard many discussions where deal teams had anticipated margin growth. Management seems like they know what they're doing, and then EBITDA reverses itself in reality.
That's Greg Schooley. He leads Bain's operational value creation team. Today on Dry Powder, I'll ask Greg how the leading private equity firms are doubling down on operational due diligence.
We think that's going to be a key criterion for returns in the next 5 to 10 years for private equity.
We'll see how leading firms are using unique data sets and cutting-edge tools to accurately forecast the profit potential of a target company. We'll also see how clear and actionable value creation plans can light a fire under management teams. I'm Hugh MacArthur, Chairman of Bain's Global Private Equity Practice, and this is Dry Powder. Greg, I just wanted to start by thanking you very much for stopping by the show today.
Well, Hugh, it's great to see you, and I appreciate the time.
Operational due diligence and looking at margins in general is a really interesting topic right now. As I look back over the last decade of returns in the private equity industry, about half of overall returns can be explained by multiple expansion. Obviously, having near zero interest rates contributed mightily to that. We don't actually have a zero interest rate environment now, and I'm going to make a posit that it's going to be tough for the industry to model out that half of overall returns are going to be generated by multiple expansion. Whatever the number is going to be, it's probably going to be less than 50%.
Yeah, this is critical. Going forward, one can't assume the same multiple expansion that we saw for the past 5, 10 years for private equity.
That makes a lot of sense, Greg. And the second big lever for returns over the last decade has been revenue growth, which has been a tremendous boon for the industry as they underwrite growthier assets in tech and in other sectors that are really on secular penetration curves and doing quite well. And it was interesting to me to note also that third on that list of the three big levers of value creation for GPs has been margin improvement. I had always thought that this was one of the areas where the industry was at its best, margin improvement, cost cutting. You tend to think of that as hand in hand with private equity and what GPs partner with management to do really well, but it seems to be the lagging value driver. Why, in your view, should private equity teams be taking a harder look at operational due diligence now? And how can that actually help the situation?
Well, Hugh, I agree with you 100%. I've looked at the same analysis, and beyond EBITDA margin not being a key driver of IRR in the past several years, we actually found on average that EBITDA margin declined in many investments. So deal teams who were expecting a few point expansion and actually saw a few points of declines. I think the drivers of that are a fewfold. Number one, there are a lot of businesses being sold from one PE fund to another. So it's harder squeezing margins on subsequent deals for future owners. Secondly, inflation has really been a dynamic that people have had trouble getting their arms around. I have one client today, which is interesting. Half of their cost structure is declining because they're a buyer of a lot of raw materials, commodities, where the other half of the cost structure is accelerating because it's skilled labor. And trying to get your arms around that, if you're an investor, is extremely complicated. The other reason for the disconnect, I think, is that often there is a operational advisor that may not really dig into the details to understand how margin can be grown, and then often is working in a siloed fashion from the other advisors, meaning that the commercial diligence findings could suggest growth opportunities in new markets requiring more salespeople, and the operational advisors suggesting that there are cost savings in sales, which obviously doesn't make sense.
I think you made a very powerful point that hiring lots of industry executives or consultants to only look at operations or only look at commercial due diligence can actually give you answers that compete against one another. I remember a famous restaurant chain example where some consultants came in and said, gee, you can actually save some protein on your sandwiches because you put a lot in there. And then a pricing consultant came in and said, you're kind of underpriced. You should be really raising price on your sandwiches. And then another cost consultant came in and said, you've got too much labor in here. And what resulted was smaller sandwiches at higher prices it took longer to get, which, as you can imagine, the end customer didn't really want.
Yeah, and I would emphasize that in a competitive bidding process, often there's a natural selection of more positive or optimistic assumptions to make the numbers work. And so you may find situations where deal teams hear growth opportunities on one side, margin opportunities on the other, and there isn't a natural function to vet whether those two assumptions can coexist or if they're actually fighting one another.
Makes a lot of sense. So really approaching this in an integrated way in order to get a realistic picture of what the business performance will actually be. So when we think about the operational due diligence part of the equation, Greg, what does good look like?
First of all, the operational diligence support is tightly integrated with the commercial diligence. The two teams need to be working very jointly. It requires daily interactions. I would argue they need to operate like one team. Secondly, the profit opportunities are grounded in bottom-up analysis. Benchmarks are great, but it's hard to build an operational plan based on benchmarks. You got to get beyond just the percent of savings against a big number. You need to understand how the business will change operationally that makes those savings possible. Third area that I would highlight is data and insights are key here. Too many operational advisors rely simply on their own experience. Now, I don't want to diminish the value of that support. These individuals know their businesses and have tremendous insight. However, they often don't roll up their sleeves and dig into the hard analysis and data to validate or disprove opportunities. And often as individuals, they don't have the same kind of tools and data sets that a more full-scale firm would have. So what I've seen in the past few years is that private equity funds are increasingly hiring full-scale firms to do operational diligence. Rich data sets from outside of the company across the industry are key. And then lastly, you need to get management's buy-in on what is possible. I have seen some disconnects where there is a value creation plan put together by an advisor. Management's not on board with it, and it leads to a lot of tension and, frankly, a poor execution of the plan. So at some point during the deal process, getting management's buy-in is critical.
When should a team actually start doing the operational due diligence, and how long does it take to do a good one?
Yeah, very good question, because a lot of operational advisors will tell you it doesn't make sense to hire us until there's a data room and access to management. And we think that approach is actually wrong. Perhaps the most valuable time to get an operational advisor going is early in the process. We are finding that with a couple of weeks of outside-in research, you can obtain high-quality insights that will improve your view of the deal. So when a commercial advisor is hired, an operational advisor should be hired as well. We typically then, Hugh, go pencils down. Then at some point when access to data and management does open up, we will do a phase 2, 3-4 weeks in length that really validates the findings or disproves the findings from phase 1 and also starts building that management buy-in that we talked about earlier.
That makes a lot of sense, Greg. What I hear you saying are 3 big takeaways, and tell me if I go wrong here, is that number one, you can't just rely on the data room. You have to actually have data from outside that is credible, that is benchmarkable, that actually tells you where you can go by cost item, by cost bucket, whatever you want to describe it. But that's not enough. You can't just talk the talk and look at benchmarks. You have to be able to walk the walk and really think through, no kidding, how are we going to operationally change this business so that these aren't just numbers on a page, but I can imagine actually operating differently at a lower cost and therefore a higher margin structure in order to delight the customers and provide the service levels that they're going to come to expect. And then thirdly, my big takeaway is, but if I'm not co-creating this in partnership with management and they're not believers, hey, they run the business. They're not going to actually just change the company overnight in a way that they don't think is sensible. So it really is that partnership that's grounded in the reality of we all believe we can operate in a different way, buttressed by the facts that we all believe, saying that we can achieve certain levels of performance if we all do that together that really make this work.
Exactly.
I think it's fascinating, the kind of unique data sets and tools that could get you out of the blocks quickly. Are there other sector-based and even capability-based data sets that you utilize frequently in assessing at the outset whether or not substantial margin improvement is possible?
Yeah, well, this is one of the wonderful things about being at a firm like Bain, where we invest so much time and money in developing proprietary tools and data sets like the Aura tool, which allows us to build censuses of any company you can imagine, private or public, using publicly available data. And that allows us to understand whether the SG&A is lean, whether SG&A is heavy, and on a functional basis where we think there could be cost savings opportunities. And that can be done quickly with very little cost. The other one that I would highlight is a data set of over 800 software and tech services companies, and it collects dozens of operating metrics on these businesses such that we can very quickly and accurately investigate the cost structure of growth software businesses to understand where they're lean, where they're not, where they may need to invest more, and where they may be fat.
Well, Greg, I've learned a tremendous amount today. I thought we were going to be talking about what they call Harvey balls, so those circles around different opportunities, and whether it's a quarter filled in or a half filled in or 3/4 filled in. But you described to me that there's a really rigorous, high-tech, data-based way to ensure that any margin improvement you're underwriting is actually there, and that there's actually a process that you can follow to make sure that you actually get it in partnership with management once you close the deal. So I wanted to end by saying, do you have an example in mind of where actually everything went right and you really exceeded expectations or met very high expectations of where margin improvement was a huge factor in making a deal winner?
Yeah, so let me give you an example, Hugh, of a private equity investment where the thesis was we're bringing a couple of companies together and they tried to integrate. Didn't work. My client was ready to write a check to be part of this, but it was all based on a turnaround. We went in and we quickly realized that it was a distribution business. The distribution center footprint was way too big for the scale of the business, that there were opportunities in procurement to source the products better, and that SG&A had gotten bloated. And the last piece of the puzzle was the sales force wasn't as productive as it should be. And we were working with management over a 6-month period. We're able to take the business from 2-3% negative EBITDA margin to high single-digit EBITDA margin, which made the deal a home run. Management was very happy to be leading a healthy business a year later.
I think it's a tremendous learning experience, both for me and I'm sure a lot of our listeners out there. If there's one area where I think GPs need to get much better, it is underwriting, cost down, margin up improvement in operational due diligence and being much more rigorous about it. And so going back to the old school way of saying, let's take an integrated view of the asset. Let us talk about the operational improvement levers, go right through the cost bar, how they tie to what we're trying to achieve on the revenue side, and why that knits together. That's what we need to get back to as an industry. And I wanted to thank you again for coming by the show today. It was very informative.
Well, thank you, Hugh. It's been a pleasure, and I look forward to talking again in the future.
I'm Hugh MacArthur. Thank you for listening.